We start today's market talk. Best investments don't demand constant attention. They quietly build wealth while you are busy living. Success in investing comes not from frantic activity but from thoughtful elimination of obvious risks and constant application of sound principles over time. In investing, the ability to disengage is a sign of fundamental health. Why Indian markets are at an inflection point. This is the most critical issue which I will discuss today.
Liberation Day that has suffered the most from Trump's tariff tantrum has been the US. The rest of the world has come up. Europe, Japan, China, India, the rest of the world has now come ahead of that level and is much higher than the April 1st level which they were in. So even though the US GDP estimates for Q1 saw a shrinkage of 0.3% because of high amount of imports, the pain will be still felt in the second quarter as piled up inventories are will run down and fresh supplies are available at a higher price. So inflation will rise and all those things will happen. So rest of the world money moves into the rest of the world and all that. Now, talk of the trade deals may be the reason for this renewed optimism in all over the world. Uh, so, what you are seeing is that every day the Trump administration spares no effort in signaling that trade deals are in offing and they are doing some advanced talks and all that thing. China has too also indicated that it is evaluating possible trade talks with the US while US stocks and bonds are going up together. But it doesn't happen like that, but they are both going up together. Now, coming to the local issues, history suggests that markets are more resilient in times of war than initially feared. While FIs continue to invest, retail and HNIs are on sidelines, as we have seen from the price action in the last few days, because the large caps are going up while mid caps and small caps are correcting. So all the retail and HNIs are cautious, watching from distance as situation unfolds. It seems the ongoing conflict will be contained in both geographical scope and duration, and government may prioritize implementation of key defense programs, and it has already started happening. Now, in that scenario, just for an example, HAL, BDL, etc., are expected to do well with strong order books. Just for information, HAL's FY27 projected EPS is around 150, 155, or is the projected EPS. So this is at around 30 times with the long gestation of earnings in front of them and big order books. Similarly, BDL FY27 earnings are expected to be around 36, 38 rupees. So it's at around 40 times now. And things are going to be better because of the supply chains are now in control. So markets are generally more resilient in times of war. So there's too much of unnecessary fear. Now comes to the key issue. With growth expectations repriced, foreign investors are returning to India as one of the best positioned long-term emerging markets. Now, what is happening is Trump's tariffs are now receding considerably, and global markets are in a recovery mode, as I told you. From 15th April onwards, FIs have bought aggressively in the Indian markets. Roughly 40,000 crores have been net purchased. I'll show it to you the FI action. Reason the why FIs are coming back is the earlier selling in India was basically repricing. We had gone up too much too fast with the expectations of around 8% real GDP growth, etc. Now markets have adjusted to 6.5% real GDP growth and 10-11% nominal GDP growth. So markets have adjusted to that levels. EPS and valuation multiples of the stocks are still in the process. So you have to factor that in. You must have seen a lot of stocks have become half because this is the normal adjustment process which has taken place. So now you have to see where their earnings visibility and go ahead with those stocks. With growth expectations repriced, investors are returning to India as a long-term emerging market. The reason is that now people will diversify their supply chains away from countries where there is a problem of tariffs, etc. Because this is not going away in a day as such. There is a global shift also away from believing that US is truly exceptional. So earlier, what the money was moving into the US is moving out of US. So that is also visible, and it is moving into various economies. Uh, China, it moved to Europe, to Germany, India, etc. Finally, tariffs may settle around 15-20%, which will be still be inflationary and disruptive for the US. Decoupling from China will persist. That is decoupling of US from China and China from US also. But if a country is a transshipment hub of Chinese goods, they will still face the US retaliation. Now, the other point would be that once the Chinese decouple from the US, switch off your volume, please. Whereas the Chinese decouple from the US, then they would do a lot of dumping in other countries at cheaper prices and all. So the beneficiaries of this trade war have to be the one which add real value to avoid being targeted by US and not be just transshipment hub of Chinese goods by just doing assembling, etc. India is attracting dedicated attention through standalone India funds and global portfolios. It is clearly visible. Now, Nifty is up 2.5% year to date. The rupee has appreciated against the dollar. It is because of a lot of money coming in and the weakness in the US dollar. And the Indian 10-year government bond yields are down and because of expectations of more rate cut in the offing. So, GST collections, I'll cover this point. GST collections reached an all-time high of 2.37 lakh crore. It may have been influenced by substantial exports to the US prior to announcement of reciprocal tariffs, but still it's a good number. It means there are corporate sales are taking place. Rise in consumption is reflected in rise in digital transaction. Manufacturing PMI for April came at 58.2. So that means there is still enthusiasm. What will be the worry would be sector dependent on external demand. Those would be under pressure seen in cautious outlook of KPIT and NSR managements. It is actually good that markets have been so adaptable and have quickly come out of the gloom and doom scenario they were in. This suggests that markets believe that Trump will not do anything to hurt them. So they have understood what is his sore issue and the bond yields part, and then they know at what level he will take a U-turn. Now coming to FIDI data, this is interesting. This is of as on 2nd May. So if you see here, the index short positions have now come down to 4 digits, that is around 8,488. So there has been a constant short covering which has taken place. And where they have added positions is Nifty. So they have added positions, cut down their or added short positions in Bank Nifty, and which is visible also with the Bank Nifty data. Midcaps, they have slightly added positions. In stock futures, they are long, and which is reflecting in the number of positions they are having. So that's why the large caps are doing really well, because these guys are long on them. Options, they have added certain short positions because they're adding long positions here. So this is kind of index options. This is kind of hedging. Stocks, they have been buying. Professionals are also cutting down their short positions and are bullish on stock futures. Same action as FIs. Clients, these are the ones who are indecisive. They are still short, and basically they are retail and other large HNIs. They are thinking or taking positions to cover their positions, etc., and they are short. And DIs in stock futures are strong bearish. There were a lot of short positions which may get covered and stocks they have been buying. Now let's see this data, FIDI data. If you see here, in cash from 15th April, they have been buying regularly. So you see FIs, they have bought roughly 40,000 crore here. And this is generally the point from when the things started to. 9th April, Nifty closing was 22,399. And then from there on, it has risen to 24,347 gradually because there's a buying here. And in if index futures, they have from 1.16 lakh positions, it has now come down to 8,488 positions. So there has been a lot of short covering, and this is clearly reflected in this up move. So one has to just align yourself with the FI's action, because generally I have found that they are the ones who are always right in terms of market direction. Now coming to the US, US markets had 9 days of winning streak boosted by solid quarterly earnings and positive rhetoric on tariffs and trade. Microsoft and Meta delivered good quarterly numbers, issued guidance that quelled economic concerns. They said that they remained committed to heavy spending on AI. This was a concern which Warren Buffett highlighted yesterday. He says that he is actually concerned that they have got large capex which they have to do with respect to their earnings and etc. So how much would be the dividends and all those issues? Impact was felt on tariffs on Apple's gross margins, and Amazon's conservative guidance disappointed. So it moved in opposite direction. Better than expected non-farm payrolls report of for April eased the recession fears, because of which, if you see, the bond yields rose up after that, because if the non-farm payroll data is good, then the chances of Fed rate cuts reduce. The Fed meet is on May 6th and 7th, that is next week or in upcoming week. And because of this strong jobs report, the 10-year yield rose. So this is the US bond yields. So they are at a precarious position, not moving down and not really going up also. The dollar index has corrected and it is below 100. It went above 100 but came down sharply. It went above 100 because the yen had weakened, because the Japanese didn't raise interest rates, etc. So because of that, yen weakened, but otherwise the dollar is weak. Brent crude, because of a lot of supply, corrected around 7% last week and has come down to 62 levels. So that is positive for all people who are consumers. Gold is also correcting now. It corrected 2.35% because it became too expensive. And now as the trade talks are progressing, the uncertainty is reducing. So I think it should come down to this 3,000 odd level, and then we can see what happens from here. Copper also corrected 0.64% because of expectations of lack of demand and lack of growth all over the world. Bitcoin was strong. It went up 3%. It has reached $96,579 to a Bitcoin. And this is basically because now the money is moving out of gold into Bitcoin, etc. So this is the reason. Now S&P 500 was up 2.92%. So it has risen from the lows, but it is still below the April highs where it was before that tariffs announcements were made. So it is recovering now. It is really poised at the 20 EMA. So let's see what happens. Nasdaq is trying to reach this rising trend line, and it was up 3.45%. I told you why, because of good results from Microsoft and Meta. Dow is also rising. It was up 3% again. It has reached that 50 EMA. Let's see if it can go above the 20 EMA. Now, this is Indian bond yields, as I was referring to. They have been constantly on a down path along this trend line. So they have reached 6.3 level. Hence, the bond prices would be going up. So that's a very positive thing and lowers the interest cost. And that is what is impacting the earnings of all the banks, and this is what the SBI chairman was also highlighting after their results. Now, India VIX was the problem. It has risen after this tariff announcement, and it tried to come down, and then again it has been rising post this post 22nd April Pahalgam event. So it has been going up, and so it is not coming out because of this uncertainty, and it is tries to go up, and then the buying comes in, or it goes up again, or the buying of puts starts off because people are taking uh, hedging positions to cover their long positions or their cash positions. So this is the real problem which is causing volatility. Now coming to Nifty, if you see here, Nifty from the total correction has retraced 61%. Of the total fall, it has retraced 61% of the total fall, which is generally what is expectations. And from here on, up to these levels, 24,800 would be that resistance zone. So this rise is generally done. After this, the resistances start playing, and it is trading above all moving averages, etc. Now coming to daily chart. So if you see here, on a daily chart, the last candle had a tall upper shadow, which is not good. That means it could not it could not sustain high levels, and there was rejection here, and it fell quite immediately here. But the moving averages are rising, so that is positive. It has taken support at around this 24, 200, 300 levels. So that is good, and there is not a problem. There is a Nifty has made a new swing high. So this was a swing high on Friday, uh, and Nifty Bank had made the same similar high last week. So what this is pointing out is that sentiment is still nervous. Hence, one has to just follow the market and not your own forecast, etc. Because if you see from here, in 15 days, Nifty has moved around 2,500 points, 2,500 points. So that is very good. Uh, all these days, though there has been some selling from the top, but at lower levels, buying has come. So there is no price damage during this week, despite all these war clouds hanging around India. Positive news, as I told you, was GST collection, RBI doing liquidity infusion, India's 10-year yield is going down, so the cost of borrowing is down, more rate cuts ahead. Dollar is sliding, US is talking about 2, 3 rate cuts, etc., and FIs are buying. Now coming to hourly chart. So if you see here, this gap provided the support from the first fall at 23,800, and after that it has been just moving around to 20 EMA on the hourly chart. 24,600 got rejected on Friday, so it came down from there. So that should be a sign of worry, but one has to watch these levels till the time this 23,800 level holds. So one should not be worried. Coming to banks, if you see the weekly chart, it made a lower high here, and similarly long long wick bodied candle. So that should be a concern. And as I showed you FI data, they are moving out and moving into Nifty, and that was reflected in the Nifty chart. So this also had a swing last week. So it went up to here 56,000, and after that it has not been able to go. Coming to daily chart, so if you see here, here it is coming out very clearly that it is now going down, and it made a big doji here. So this is looking weak. I think it can go down to these levels or 20 EMA 53,600 odd levels, where it can take support and then move up, because there is no incremental positive news which is coming for now Nifty Bank. Most of the good news is in the price. Now HDFC Bank didn't fall while rest of the banks were falling. So this, till the time it is above 1880, this is strong, and this was the reason why the Nifty was supported last week because it maintained some strength. The last week's strength came because of Reliance. It moved up 9.38% last week. So it broke through that declining trend line, and now it has gone up. So let's see up to what level it can go. Initial target should be around 1500 odd, uh, based on the momentum which is visible. So RSI is still also strong, so no problem here as such. And it is evident that there is FI buying which is taking it up. Midcaps were flat, made a proper doji. So there's not much of momentum here. It went up to 12,400 odd levels and has come down. But it has risen from a high, and till the time it is about 20 MA, it is positive, but not much of strength here. Similarly, small caps, they corrected a bit. Hence, if the mid caps and small caps are not doing well, portfolios will not be doing well. Till the time this is above this 15 odd thousand level, then it is positive. I'll cover two stocks. First is CSB Bank. CSB Bank is a quite old bank, and now they are doing restructuring. As evident from the results, asset quality is stable, aided by lower slippages and healthy recoveries. Lower credit cost and healthy business growth will help the bank attain its estimated ROA. Robust growth in other income offset the impact of lower NII, net interest income, leading to beat on net revenue and pre-provision operating profits and PAT. Gross loan book grew at robust 20% year-on-year and 10% Q-on-Q, led by robust pickup in SME corporate loans. So there is why I'm covering these two stocks is because these guys are concentrating on SME loans, and that's why they are able to show growth as compared to others. And loan growth or advance growth of 30% year-on-year and 10% Q-on-Q is really strong. Deposits grew 24% year-on-year and 10% Q-on-Q, led by term deposits up 29% year-on-year and 10% Q-on-Q. CASA deposits rose 10% year-on-year and 11% Q-on-Q. The management had guided for a NIM of around 4% in FY26. All NIMs are falling. It has curtailed growth in three businesses: personal loans, two-wheeler loans, and MFIs, because that is the vulnerable part of right now lending. With the unsecured loan book shrinking, slippages are likely to reduce further. Now, if you see their results highlight, net interest income fell year-on-year 3.8% and 1.1% Q-on-Q. This is because of lower NIMs. Contraction in NIMs due to change in portfolio mix, because they have gone for more wholesale and SME loans, less retail loans, which give higher amount of interest, and a pullback on high yielding personal loans and MFI loans, which I told you. Higher cost of funds has also impacted all these banks due to liquidity challenges which were there in the system earlier, and higher FD costs because they are taking a lot of term deposits as compared to CASA deposits. Now, the good part for them was the other income. Other income rose 94%. This other income is income from insurance, transaction, banking fees due to wholesale loans, and treasury income. So this is the one which supported them. So the net revenues were up 29% year-on-year and 26% Q-on-Q. This helped them, though NII was lower. Operating profit rose 38%. Provisions and contingencies also rose 178%. So they have done more provisions because they had higher operating profits, so you can do more provisions. Profit after tax grew 25%, which was best among all the banks which are coming up with this thing. Now, cost to income ratio has declined, so which is positive. It is on a constant declining path, so their cost is declining. Cost of funds has gone up, as I told you, because they're taking more term deposits, so the cost is higher. Spreads have declined, and this is the problem. And NIMs have declined. So NIMs have come down to 3.75 from earlier last year they were 5.1 and 4.11 because now the uh, cost of money has gone up because of liquidity issue and because of interest rate cut the cost of borrowing has come down. So that is the NIM problem which is impacting all banks. ROE is stable 1.8. ROE is improved, return on equity to around 18.8. So if you see the balance sheet, the gross loan book is up 29% year on year, deposits up 24%, CASA deposit up 10%, and credit to deposit ratio is up 370 basis points. So which should be a concern actually, that they are not getting adequate number of deposits as compared to amount of advances they are giving or loans they are giving, 29 versus 24. CASA ratio has dipped because people are preferring more of term deposit. Asset quality is stable, though gross NPAs have gone up a bit uh, year on year, and that's why the management has turned cautious. Now coming to their profit and loss. So if you see here, net interest income is generally the same. It is in that same range of 380 to 370. So there is no increase, but the rise came in other income, which have nearly gone become 3x now. Uh, Expenses, etc. So the EPS has improved. The cost to income ratio has come down, so that has helped their profits. Profits have also gone up. NIMs have declined. So the NIMs which were in Q3 or Q4 FY24 were 5.1 have come down to below 4, and they are guiding for around 4, not more than that. ROA is stable, but it is at 1.8, and they are guiding that it will be in the same levels. So that should be that has to be, these are the things which needs to be watched. Now coming to their guidance in terms of income statement, what they are guiding for is around 20-25% growth year on year in net interest income and a EPS of around 44 for FY26. So which will lead to an EPS growth of around 29% for FY26 and 21% for FY27. So this is a bank which is having a turnaround because they were stuck because of their higher cost of borrowings and other issues. So book value is expected to be around 298 in the for FY26, and presently it is at around 1.2 book value. So it can easily trade at around 1.4 times price to book based on forward earnings. So at 1.4 price to book, this comes to around 420, 430. So that should be the first target for FY26. Let's see the chart. Now, because of declining performance, this bank was on a declining trend line and it has broken out from there. So now on the weekly chart, it is trading above all moving averages and they are all trending upwards. There is increased buying also. So it has reached this now 350 odd levels. When I had told to buy this, this was the point where it was breaking through this declining trend line, which was indicating that things are becoming better. So every dip is a buying opportunity up to around 320. You can get a target of around 420, 430 if the things are okay with this bank. Next is SBFC Finance. It's an NBFC specialized in secured MSME loans and gold loans. It is primarily, its customers are entrepreneurs, small business proprietors, self-employed individuals, and salaried professionals. Expect 27% to 25% AUM PAT CAGR over FY 25-27. Addressable small business lending is estimated at 22 lakh crore, showing huge potential in the secured MSME space. Focus, and these guys have a AUM of around 8,500 crore right now. So you can see what is the kind of opportunity which is available. Focus segment is customers borrowing between 5 lakh to 30 lakh. They are looking at those ones. strategy is to prevent against economic downturns by keeping a part of its book in gold loans. So they have 17% of total AUM in gold loans, which offers comfort on asset quality. They are present in 16 states and 2 union territories. It has been making significant investment in the last 5 to 7 years in the IT process, digitization, manpower, branches, and distribution. So now, if you see here, this is their distribution: 205 branches, 164 cities, 16 states, 2 union territories. So they are there in most parts of the country. Uh, they're focusing on 5 to 30 lakh ticket size SME loans. The market size of this 5 lakh 30 to 30 lakh MSME loan is around 3.2 lakh crore, growing at 24%. The total MSME market size is around 22 lakh crore. So smaller ones is still, there's a sufficient opportunity. They have improved their credit underwriting and risk management framework, which is reflected in their asset quality. So this is their this quarter's earnings. So if you see here, quarter to quarter, their interest income on loans was up 7% and 30% year on year. Total income was up 29% year on year. It's a strong growth. Pre-provisioning operating profit was up 32%. Profit after tax was up 28%. So very strong growth they have shown. Coming to financial year performance, interest income on loans for the full year was up 34%. Total income up 28%, pre-provisioning operating profit up 46%, and profit after tax up 45%. So strong growth. They did a EPS of around 3 rupees 20 paisa this year. Now coming to their AUM, as I told you, it has crossed 8,500 crore. So at the end of Q4, it is 8,747 crore. Yield, that means they are on their lending, they are earning around 17%. Spreads are 8.53. So that is yield minus cost of funds is spread. So that is strong. Cost to income has come down. So they have reduced their OPEX. So OPEX to adjusted AUM has come down to 4.62%. So the total operating cost has come down. Gross NPAs were slightly higher in Q4. So, but it is still not bad. And return on assets on AUM is roughly 4.52. So it is generally in these 4.52 levels, while ROE is improving and has reached 13.14%. So generally they are now stabilizing. If you see their earnings, they are expected to grow around 25-30% over the next 2 years. 2 years, similarly in profits also. So if you see here, the present book value of theirs is roughly around the 30 rupees. So that's why they are at around 3.4 price to book now. And they, if they are expected to grow around 25%, it would be around 37 to 38 over FY26. So at 38 price to book, they can easily trade at 3.4 times price to book with the kind of growth they are having. So they can go to 130 if they handle their NPS, etc., and provisioning properly. And they increase their provision coverage ratio. So ROE is improving, though it is still low, but it is improving. ROA is around 4. So this is generally best in the industry operates. So if you see their chart, they have been generally stable in this range of 80 to around 100 over the last few months. They're not fallen much, risen much because of stable performance. So it came down to around 82 on April 7th and then rose to 110 level. And after that, after the results, it has started correcting. So somewhere closer to this 93, 94 level should be an adequate opportunity to buy this stock for long term. Thank you. I have finished.